Punita, good morning. Thank you for joining us.
Good morning.
I've seen markets turn volatile, but I've not seen craziness on both these sides. About a year ago, there was a euphoria in some of these consumer tech and fintech stocks. Then there was mass panic as anchor investors were selling, and now there is a smart recovery. So it's like in 18 months, you've seen investors moving, turning completely 180-degree.
Yeah, you're right. But it's not isolated just to the consumer tech names in India. You've seen what's happened in NASDAQ. The market in the tech stocks in the US crashed as well. And it's recovered very, very sharply. In fact, from October lows, NASDAQ is up over 35%. That's like a sign of a bull market. Typically, these kinds of things happen in bull markets. But I don't think we're in a bull market. But yes, the valuations have really swung in terms of the pendulum. They became, I guess, relatively cheap, and now they're going back to some kind of normalcy.
Where do you think markets are headed? We've had a good summer rally, the summer rally of 2023. Do you think this is as good as it gets, or this could extend itself?
I think the momentum is actually quite strong, and FII flows to emerging markets have really picked up. So that's a positive sign. The other positive sign is on the interest rate front. Now, if you look at the Fed watch, about right now, there's a 40% probability of a rate hike that's being priced in by the markets in the US. Um, that number in May was more like 10 to 12%. If the Fed doesn't raise rates, then we have more legs to the rally because the markets are not pricing in a high probability of a rate hike. Now, if the rates get cut, that's not being priced in either. So then we could have a big rally. So either if the rates go up, that's not being priced in, so markets could collapse. And if rates get cut, then markets would rally. And I think India would follow because markets are hugely correlated. So a lot of this is based on rate and interest rates where they go. The other thing is that the macro environment is a little bit more benign. The debt ceiling talks in the US have gone relatively okay. So that fear is out of the market. Inflation is cooling off just a little bit, though I think inflation is still a bit sticky in the US. India, it doesn't seem to be as bad as what I see in the US. And the recession, while there are signs of a slowdown, it seems like a slower slowdown in terms of like no fears of a deep recession. So the macro front is looking relatively decent. It's the geopolitics that could come in as a negative surprise. But right now, there's no negative surprise that one can see in the immediate future.
And that really seems to be the case because if I look at the European markets also, Punita, they've been edging higher despite the data flow from Germany. I mean, yesterday you had poor German factory orders, RBA rate hike. That's not really impacting the European markets move. Or for that matter, the S&P 500 index as well, which is also sitting at a year high. What one is seeing, Punita, as of now is that it's turning out to be a bit of a synchronized move across world markets. Do you think it'll continue to remain so, or can India really outperform the rest of the EM pack? And more importantly, right now, how does the Chinese market stack up?
Well, certain sectors in India have already broken out of the pack. So if you look at Indian real estate, if you look at Indian consumer discretionary and consumer staples, these sectors have outperformed their counterparts in other emerging markets. So certain sectors have done quite well, but then the valuations of the Indian markets and Indian sectors are also above their own historic averages, as well as they're trading at a premium to emerging markets. So I think right now, of course, we are seeing very strong breadth in Indian markets. In fact, small caps are really rallying and breaking out of the pack. It's the large caps, as Nipun said, that's where the focus isn't there as much. I think we'll have to, at some point, this will consolidate, but right now the momentum is good. But I think at some point, the valuations will start looking pricey, and then the risks, then you have to start looking at risks. From a growth perspective, India is looking better than China, but then China's just had a stimulus. And so that can keep China going for a while.
Do you think it's a matter of time markets will shift focus from China and oil and economy and valuations to elections? We are almost a year away from the election cycle, and that whole nervousness, chatter, and assumptions will start kicking in.
Maybe, but I think, at the moment, the Indian economy, Indian political situation looks relatively stable, quite stable. I don't think anyone is expecting a big negative surprise in the elections. So unless there is some big change between now and then, which I don't expect, but one never knows. We are a democracy. We don't know how the voter is going to vote. But at the moment, I don't think that's going to be a big negative coming up. And I think India is going to move along with global markets, particularly emerging markets. I mean, the one thing you have to look at is that emerging markets are beginning to see flows after a long time, and Europe as well. And so Europe and emerging markets are beginning to look more attractive compared to the US after a long time. And if emerging markets rally, India is not the cheapest emerging market, so it may not be the biggest outperformer in emerging markets. China, maybe. We've already seen Korea and Taiwan do quite well this year. Some of the other markets might actually do. Latin America has done quite well this year. So India will, from an EM point of view, if EM is doing well, India will also do well, but maybe not as well as the others. But there is some focus shifting to Europe and emerging markets this year.
You did speak about rate cuts as well, triggering a fresh bout of a rally for the equity markets. This, of course, will bode well for a lot of rate-sensitive sectors. You touched upon real estate, etc. What's the outlook when it comes to financials as well?
See, I think financials are still looking good. They're not terribly expensive, especially the PSU space. And I think India as an economy is growing. Credit growth is strong. And in an interest rate environment like now, I think generally banks also do well. So I still think that financials are a good place to be because it's a good play on many, many sectors of the economy, including capex, industrials, retail, corporate. So I think that's a sector I would still bet on.
Okay. Well, Punita, always a pleasure. Really appreciate you joining us, and thank you for your valuable inputs. I'm going